I'm a lawyer. That's what we do. We answer with it depends. Okay. So today it might be true, but if nothing changes, as you know, laws they're set up. Sometimes they change, depends on who's in office, whether you're Democratic, Republican, you know. So but if nothing changes, estates over $5 million are scheduled to be subject up to a 40% estate tax after 2025. So think about it. You're in 2022 now. Look at the value of what you own now, and then you know it's going to go up. So by 2025, you actually might be closer to that 5 million than you think. If you add the value of your home, life insurance proceeds, your retirement accounts, you might be near that $5 million mark, even though you think you're not, because you're looking at just your regular bank account and checking account, not taking into consideration everything else that you have, right? The government looks at the value of what you own. Okay.
And given this past real estate climate, most people's wealth definitely increased due to the housing market. So for real estate owned, absolutely, that's a very good fact.
Absolutely. All right, you're up.
Myth versus facts. Your tax preparer is responsible for any mistakes on your return.
That's a good one. That's a good one. And yet I have learned that answer.
Hopefully not
just like the other one from personal experience. Let's see. Myth. They put myth, although it should be.
I think I agree. However, let's find out the correct answer. And it is absolutely a myth, although I absolutely agree that it should be. And to a certain extent it is, but it still doesn't alleviate the taxpayer from their responsibility, which you assume responsibility of the tax return by your signature. And so you are legally responsible for all information on your tax return, even if it's prepared by a professional. And so my advice to everyone is to just ensure that you are reading through your documents, make sure you understand what you're prepared. Do not take lightly because someone else is providing a service for you, that it eliminates all responsibility from you. And so to answer, although it should be, the preparer is also equally responsible, and they pay it in the form of fees and fines from the IRS given to that preparer, but it still doesn't eliminate any type of penalty or tax liability that may be a result of an erroneous tax return.
All right, so hopefully from these myth versus facts, you guys got some good tips. Understand, don't be like Michelle. But this was like prior. This was like younger Michelle. not Michelle now, but this was young, wild and free Michelle, just out of control. So it's time for
not the fake LJ. I love it.
It's the fake LJ. Look, and I had to take a picture. Recent picture. Okay, so yes, I'm the fake LJ. So the first bottle is going to be like the Chardonnay. Y'all already know how I am with wine. I'm learning myself, so I'm gonna try and tell y'all what I taste. While I try to do that, you guys are welcome to go ahead and sip on yours. You can put in the chat, or Shaniqua, you can tell what you're drinking and what you're tasting, because
I'm ashamed to say what I'm drinking. It is a Chardonnay. I did know we were doing that. I was late getting there, so I have one of the little small bottles of wine that doesn't necessarily come from the wine store, but it is a Chardonnay Woodbridge by Robert Mondavi.
Okay, what it tastes like?
Let's see.
I didn't swirl and snip. I mean, LJ, he's gonna watch this. I'm sorry, I forgot. We swirl, look at it,
then smell it. That's what we learned the last time, at least anyway.
That's what we learned. All right.
I believe you're supposed to also hold it in your mouth. I'm not sure if it was on the Chardonnay or another one, but mine was good.
That's what happens when you leave us alone, LJ. We go rogue. I don't know, but I can tell you, I like this Chardonnay better than the last one that we did with the wine and wills. I actually do like this one better. I don't know what grapes I'm supposed to taste. I don't even know what I'm supposed to pair it with, but I actually do like it. It's a lot smoother. And I don't know what fruit it tastes like. So sorry, guys. Fake LJ is just really
And then someone just put in the chat that LJ is going to scold you.
Yes. Yes. I have a client who is very wealthy. His motto is the cheaper the better. Unreal.
I think we heard that from someone last time as well.
I don't know. That might be
LJ wouldn't agree with that one, but okay.
I tried. I'm trying, guys. I'm trying. All right, so we're gonna go on to the estate planning 101 part. So yes, I always like to repeat, because the more you hear it, the more you'll understand it. And of course, you'll be out there. So when you hear craziness, you'll be like, no, no, I know Michelle Bella. She said absolutely not. So this is what it is. What is a will? It's a document that says who gets what items and who is in charge of making that happen. It is a court filing, which means it's public record. It can be reviewed, has to be reviewed, and approved by the court. But it's public record. So everybody gets to hear your business. That's just what it is. Like, I can go on the website now, register of wills, pick a county. Right now, I'm located in Maryland, and I can put in anybody's name. I can put John Smith in. It's amazing how many people were actually named John Smith who passed away. And you click one, you get to see all the documents that were filed in their probate matter. And I can pay 50 cents a page, download the whole thing. I don't even know who John Smith was, but I can have all his stuff. I mean, that's just what it is. So it's definitely public record. So that's what a will does. You will be in court handling probate if you have only a will or you don't have a will. So what is a trust? A lot of people are like, well, I'm not rich enough to have a trust. Well, you don't know what a trust is. So the trust is really a substitute for the will. So it does the same thing, tells you who gets what items and who is in charge of making that happen. But it's a private document. It does not get filed with the court. Who knows what's in the trust? The people you list. They will know what's in the trust. Okay? So it doesn't get filed with the court. It's not public record. So you can transfer assets to the people you wanted to. Assets is just a funny name for stuff. Just think about it that way, stuff. Okay? Don't think you got to have, what's that, Richie Rich kind of lifestyle. It's stuff. Okay? What is probate? You hear that word a lot, and I know I've probably said it like 4 or 5 times already. Probate is the court process of distributing decedent. That's what we call the person who passed away. So it's a court process of distributing decedent's assets and clearing of their debts. So, quick myth or fact, do all of your debts die when you die? Absolutely. Your debts do not die when you die. People say, well, what does it matter? When I die, it's going to be gone. Absolutely not. Your family is stuck with your debt. They don't want that. So let me see this question. Are there tax liabilities associated with the trust? So there are. Remember, IRS is going to get their money. You can minimize tax liability and you can dictate whether you want any tax that needs to be paid on certain stuff or assets that you're passing on. You can dictate whether, if there is a tax, it gets paid out of your trust or the person you're giving it to has to pay it.
And there is a tax return that's specific to trust.
Yes, there is.
So you don't avoid, to Michelle's point, you don't get a chance to avoid it. That trust will have to file a tax return. So absolutely.
Yep. That's exactly what happens. See, this is why I bring on a tax person, so that you guys can hear from me and hear from her. All right. So what is estate planning? It sounds fancy. So what is it? It's the process of making sure your family, your team, especially if you own a business, small business, medium business, large business, you still have a team, and clients aren't left with a mess if something happens to you. You have to have stuff in place. If you are unavailable for whatever reason, somebody has to handle this. You can't just be like, oh, tell your clients, oh, well, she went in a coma yesterday, so the business shut down. That's not how that goes. There's a whole process to shut down the business. You still got to provide a service. You still have to pay your team people, especially if you're still alive. They don't want their money. They're not working for free, not in this climate. So, that's the whole process. It's just Look at it as not planning for your death, but you're doing a love letter to your family and a love letter to your business, so your team and your clients, because you're making all the decisions, you're making sure everything's okay. So all the people have to do, whether you're in a coma or you actually pass away, all they got to do is just grieve and be emotional. I mean, we're human beings, we're people. So we're going to have feelings. They're going to be able to deal with it because why? You've already made your decisions. They don't have to. That's a love letter to them. Okay.
And I'm glad you said that, because a lot of times people, I think, associate estate planning with their personal lives. And you are absolutely correct in the estate planning. It exceeds into your business, and it should be. It should be a part of that planning process as well.
Yes, your business is an asset.
Mm-hmm.
It is. You're putting in blood, sweat, tears, money, all kinds of stuff in it. It's an asset. It has a value.
It looks like you have a question about trust in there as well, and assets being protected.
Does the trust protect the assets from being offset to pay your debts in death? I'm trying to understand the question, but I'm gonna take a shot at it. Make sure I understand what you're asking me. So again, your debts don't die when you die. So they got to be paid somehow. So if your debts, let's say if you have a house that's 500,000, your debts come up to, let's say 400,000, because you just bought the house not that long ago. You don't have other money that can pay that $400,000 debt. Because let me explain to you, Wells Fargo, Bank of America, all them people that had that mortgage, they're gonna want that money. You may have to sell that home, even though you put the home in a trust. Your trustee may have to sell it to pay off your debt. So I mean, you can minimize, but it won't take away. So I think I understood your question. Like, it's a complete offset. Like, okay, well, it's in the trust. I owe this money, but because this stuff is in the trust, I don't have to pay this money. That's not how that works. Oh, wait. What type of assets should be in the trust? Okay. You are really getting at me, okay, today. So, the type of assets that should be in a trust. So definitely, first of all, stuff that's in your name only. Yes, because that's how you can help avoid going to court and probate. So example, if you have real property, you want that to be in there. Life insurance proceeds, you don't have to put them in a trust. Some attorneys recommend that. What I recommend is that you put the trust as a contingent beneficiary. So that way there's always something to catch it. Because if there's nothing to catch it, Maryland or whatever state is they have their own laws, and they're gonna come in and it'll be in the unclaimed property department, right? So what I do that for life insurance proceeds. Like, you can list your beneficiary, but if that beneficiary is unavailable, maybe they're laying next to you in the same hospital room, both of y'all in a coma together, or maybe they've passed away or something like that, you need something to catch it. So I do that for, I don't put it in the trust, but we list the trust as the contingent beneficiary. Your retirement accounts, I mean, they have like all these new, not new, but what's the name of the law that came out? Shaniqua, the CARES Act. Ooh,
Mm-hmm.
I might have had too much of this.
Not yet.
Yeah, with the CARES Act, retirement accounts are handled a little bit different. So you can still put those in the trust, but I do not recommend putting vehicles in your trust. It's so much easier to just go to DMV and fill out the paperwork saying who you want to have the vehicle if something happens to you. Let's be honest, DMV, you guys, some people call it MVA, whatever it is, motor vehicle people. They have a lot of turnover. Some people understand how to handle trust. Some people don't. They may not have gotten the training. You don't want all those issues, and you don't want to have to wait. So I usually tell people, don't put that in the trust. What, you're just coming up with all these questions. So why have a trust if your debts are going to eat up your money? Your debts aren't always going to eat up the money, but the thing is this: you want your assets to go to who you want it to go to. If you don't do a trust and you only do a will, first of all, you're going to end up in probate court. Only having a will or not having a will, you're in probate court. which can take 3 months, 6 months, couple of years. You don't know. You're on the court's time. And then they have to review and approve that. So your family is sitting and waiting to get these assets, but they can't do anything till the court is given the thumbs up and okay. But when it's a trust and things are retitled and stuff, that stuff can happen, in the attorney's office. That stuff can happen being passed on to the people you want it passed on to. And it doesn't have to deal with the whole court process. Plus, if you have minor children or you're leaving stuff to a minor can't take hold until they're an adult. But you put it in a trust, they have access to it. So a trust is better when you have like definitely minor children, if you're a blended family, more than one marriage, you're an investor, you got all these different properties, stuff you want to pass on. You don't want conflicts. You don't want your family fighting over all that stuff. It definitely can work for you. So is it better to have your assets in a business name, and can a business have a trust? So depending, that's where you start going into like the advanced asset protection, and that's like a whole nother webinar. However, I do tell people, if you have a business of your own, assign the interest of your business to your trust. Let's see. They said too much wine. Why? Why do you think of the mantra? What do you think of the mantra, own nothing and control everything? So from an estate planner's point of view, right? That is like one of the best ways to do asset protection. You control it, but you don't own it. So that means, like, for example, if you have a child who becomes an adult, but you knew they was special growing up, they gonna have like those 4, 5, 6, 7 spouses. Stuff, they just that type of kid. They gonna have that many spouses coming to get their stuff. They're gonna have gambling debt. They're just gonna be betting it all. They're gonna have creditors coming left and right, like 20 credit cards. They don't own anything. It's kind of tough for people to come get what you left them if they don't own it. But if they have access to it, it's okay, but they can't control it. So that's the only thing when it comes to that. So even though you may not own it, but if you can show that you have control over it, they might come get creditors might be able to get you because you have control over it. So they're going to make an argument. But if you don't have control over it and you don't own it, that helps you. Now, you may have access to it, but if you don't own it and you don't control it,
makes it a lot harder.
Yeah, it makes it a lot harder. Now, that doesn't mean that they can never penetrate that. I will never say that. I will never guarantee that. But it does make it harder, I don't know. This person like grilling me left and right. I might need another sip.
I'm gonna take one too.
I know I'm in the hot seat. I feel like I've lost 10 pounds over here. Okay. Wait. Is my will valid if my attorney drank too much wine when she prepared it? I'm gonna plead fifth on that one. So here we go. Spooky Wine and Wills. Let me see where we're at. 6:56. Okay. So we're gonna make this quick. But I love the interaction. I love the questions. Keep it coming. This is how we actually educate, So this is the revenge of till death do us part. We all know where that phrase comes from, right? So I always try to do a real life story, guys. I do. Who do you think the mystery guest is? Somebody said Kanye. No, I'm going to help you out. The person is deceased. Not just mentally. I mean like full-blown deceased.
I have a good one. I don't know if this is your one, but I have a good one because that was a huge thing.
Oh, this is too funny. Not Kanye. Then the other one said, somebody said not LJ. No, it's not LJ.
Oh, goodness.
James Brown. No. Somebody said Spooky. Betty White. No, not Betty White. Oh wait, there was a question I missed. What happens when there is a will? The estate was left to the siblings. The siblings don't agree on selling the estate, so now the estate is just sitting there. Okay, so if there was only a will, you should be in probate court.
Mm-hmm.
And if the siblings cannot agree on that, there should be some sort of motion or document filed to have the judge make that decision.
Mm-hmm.
Since you guys can't agree, you're at an impasse. Let's see. Betty White, Michael Jackson, or Prince. I like those. But guess what? All of you are wrong. We're gonna go with Mr. Larry King. Y'all didn't see that coming, did you? Yeah, Larry was gangster. I'm trying to tell you, Larry was gangster. You think he wasn't? Larry was gangster. He absolutely was. We absolutely know that Larry King was this great TV personality, radio personality. I mean, this man was in business, broadcasting and doing what he does, doing his thing for like over 50 years. It's crazy. And he was still doing all of that, when he got sick and he passed away. I think it was January of last year, right? January 23rd, 2021. It's crazy, crazy, crazy. So with that career, y'all know Larry got some money. He got some money. He had approximately about $50 million estate. You wouldn't think that with him being a broadcaster, but think about how long he was doing it. And honestly, I remember he was on CNN. So at that time, if Larry King said this happened, anybody questioned Larry King? It happened. And he's on CNN. It happened. Larry was making the big bucks. So his estate was approximately 50 million. But however, Larry was a ladies' man. He was a ladies' man. He was married 8 times. He married one woman twice.
Wow.
I know. No one saw that coming. I didn't. But yes, Larry, his first marriage, he was 19. But back in those days, they did get married early. So he had 5 children, different, moms, 9 grandchildren, 4 great-grandchildren. And honestly, the 7th wife, when he died, he was in the process of divorcing her. And the crazy thing was they were fighting in the divorce.
Wow.
But guess what? When he died, they were still married. The divorce wasn't finalized. So who had the last say? Wife, the 7th wife. But Larry, I guess Larry tried to change some things. So before he died, he some of the stuff we're not going to know, and it's just presuming that he had a trust, because again, remember, trusts are private. Larry actually had a new handwritten will. So in some states, to create a will, all you have to do is you can handwrite it, date it, sign it. Some require witnesses, some do not. And, that can be legitimate. So, that's what Larry tried to do, because he was like, yeah, let me get my stuff in order. Because it's not like he was new to the game. Like, Larry been around that divorce rodeo multiple times. So he knew what to do. But that's what he tried to do. And he tried to make sure that $2 million out of his estate will go to certain kids. But unfortunately, 2 out of the 5 kids that he had mentioned that's supposed to get that extra $2 million, they predeceased him. And it's unfortunate that stuff kind of happens. However, 7th wifey was like, look, I need more than what you're trying to give me. Because Larry was like, well, look, I'm going to give you $1 million, and that'd be like an annual payment. And she's like, $1 million? Dude, we've been married 23 years. That's what you want to give me? 23 years, you giving me $1 million? I'm sure she kind of knew what he was sitting on, So they actually were in court for a couple of years. So they initiated 2019. He died 2021. So that divorce is real when you in court that long trying to fight, So it just didn't, it just wasn't going well. But of course, when he passed away, he's still married. So I think he was in California. So in California, that's a community state. So, they're looking at, it's not equitable. Like Maryland is equitable, meaning they try to look at what's fair. California is community. It's like, hey, when did you buy this? Who owns it? And all that stuff, that determines where stuff goes. So she's like, hey, we're still married. I'm gonna get more than this $1 million. Technically, all this should be mine, or at least part of it. But of course, his ex-wives and his children are like, wait a minute now. Pops wanted us to have some of this, so you don't get to have majority of that, at least 50%. Because I think that's what they were saying in California, that she might have been entitled to 50% of that. So that means instead of getting that $1 million in a year, if he's $50 million estate, how much is that for her?
$25 big million.
I don't know who was wrong. I don't know whose fault why they was divorcing, and I don't even care. However, that woman know her numbers. 23 years of marriage. You about to offer me $1 million. You died. I'm in a state that might give me 25 million. Oh, I'm fighting all day long. I'm okay with that.
But question though, if he had a trust, would his trust had dictated something other than what the state? Would your trust supersede states' regulations?
That's the question. So this is the thing. First of all, states vary. So I'm going to speak in general language. So this is the thing. You can't give away what you don't fully own, right?
Mm-hmm.
And so when it comes to like the trust, you can't just throw stuff that's owned by both people. And then you take it, put in the trust, and try to leave the other person out.
Gotcha.
Like,
so if the state already recognized, for instance, in real property that both spouses are ownership, you individually couldn't put that real property in the trust to keep it away from the other person. That makes sense.
Right. You can't do that. And unfortunately, like you'll see that a lot. People trying to do that when they're trying to get a divorce, like Larry King and them. Not saying that that's what he did, but when people are trying to get a divorce, they're trying to hide assets. Right. So some people try to use their estate plan for that. So let me go ahead and clear the air now. Michelle Bell doesn't do that. If you're trying to hide assets, I'm not the attorney for you. I will let you, and hey, there's names I can give you. You can find out if those other attorneys do that. I'm not going to help you try to hide assets. I'm not that kind of attorney. I need to be able to sleep at night. That's just not me. Mm-hmm. So, yeah, he really could have. That's quick. I'm gonna try to. So it's more to the story, but because of time, I'm gonna try to jump forward. But maybe I'll do the whole story later on another recording or something, because it's very interesting. I mean, really, the guy had 7 wives. He was married 8 times because he married one woman twice. It's very interesting, his story. We talked about this part. And then, so lesson number 1, update your estate plan as soon as divorce is inevitable. So think about this. When most people are married and they start doing these documents, who's the first person they put as the beneficiary?
Your spouse.
There you go.
Usually.
You start putting your spouse down for everything, and especially making your medical decisions and your financial decisions, usually list your spouse first. If you're trying to divorce that person or they're trying to divorce you, please think about this. If something happens to you and you're sitting in a coma and you never updated your documents, who's making that medical decision for you? Who's making that financial decision for you? I mean, that person's a soon-to-be ex for a reason. I don't know if I want them making that decision. They might unplug me to plug in their phone. I mean, you don't know. Or they might have a flashback of something I said or did months ago. And there's nothing I can do. I'm at their whim. So please update your documents. If divorce is inevitable, please update that. Do not try to hide assets, but please update, those certain documents. You may not be able to disinherit spouses. So some states are different. Like Maryland, yeah, they frown upon trying to leave your spouse out of everything. Maryland is like, no, that's your spouse. You cannot disinherit them. So disinherit just means you want them to be treated as if they predeceased you. The person is still alive, but in the paperwork, you want them to be treated as if they predeceased you. But Maryland doesn't allow you to leave your spouse with nothing. They actually have a law to say what the percentage is. If I'm not mistaken, I could be wrong because I don't have it right in front of me, and it's a long day, but it's somewhere around 2/3 or something like that. You have to get, minimum would be what you can give the spouse. Amend your will or trust. Wait. How do you marry an eighth wife if he died fighting a seventh wife? Remember, he married one of the women he married twice. So he's been married 8 times, but he's been married to 7 different women. One of them he married twice. Can you have a first, second, etc. person left to make your medical decision? Yes. So that is what I always tell my clients. Name 3 people. So they're going to be in consecutive order. All right. If the first person says no, if you're in a coma, you don't know. They said no. You can't force them to make the decision for you. So you have the first person. If they're unavailable, hell, they could have been in the same accident with you. You have a second person that you name. Second person's unavailable or can't make it. They're just too emotional. You have a third person. Rarely will you have all 3 people not make a decision. So always try to have 3 people listed. However, if your spouse or soon to be ex-spouse is listed as number 1 and they're able and willing to make that decision and it's in consecutive order, I mean, your second and third person, I mean, there's nothing, what they're going to do? They're second and third. the ex-spouse is listed as first, and you gave them all the power to make that decision. He said too much wine for me. If mom first, if she deceased, then son is second. So yes, as long as the son is an adult, not a minor. If one of the people named is a minor, who makes the decisions then? So first of all, if you had an attorney who's actually paying attention to what they're doing, they wouldn't let you name a minor. Or if the client is just insistent on naming a minor, then they would need, I would have them have a guardian listed as well, and the 2 of them serve together. But you try not to have a minor do that. If one of the people, yeah. So I just answered that question. Amend your will or trust. Let's see. Lesson number 2. I'm trying to fly through these so that Shaniqua has time. So lesson number 2, work with experienced estate planning lawyer for creating, updating documents, especially if you have a blended family. Yes, everything is all good and dandy when everybody's alive and everybody's together, especially blended families, right? Because I mean, honestly, in this day and age, that's the norm. It goes crazy if a biological parent is sick or the biological parent dies, right? Not all step parents are going to live up to what they said they would. They may not all look out for the child that's not biologically them. That's a real possibility. So you can take all them decisions out their hand and again, create the estate plan, which is what? A love letter to your family. You've already made decisions. All they have to do is grieve and make sure your decisions are carried out. Right. And especially when it comes to blended families, because you really don't want, certain kids left out. It's not fair to them. There is something called lifetime asset protection trust. So that's the one where you can create a trust for, let's say, your children, and then it keeps going to their children, their children, their children, their children, their children. You can create that for them. Can't create that for yourself. So if you were to have it, your parents would have had to create that for you, or someone else would have had to create that for you. You couldn't do it for yourself, but you can do it for others. So honestly, Larry King could have done that. And that would have helped with the children, the grandchildren, and the great-grandchildren. Instead of now everybody trying to fight for a piece of that $50 million estate. Review your plan often and update after births, death, divorce, and inheritances. Don't DIY. Okay, listen up. Your estate plan is cute. It's in a binder. I get it. You're happy. You signed it. It looks beautiful. It is not a rotisserie chicken. You do not set it and forget it. That's not how that works. Okay. Your life changes. Your plan should change right along with it. When you made your plan, you might have lived in Hawaii. You now live in Minnesota. You don't even have that property anymore that you had out there. Matter of fact, you might have left a spouse out there too, and now you got a new spouse. You may have more children. It's all kinds of stuff. When your life changes, your plan should change as well. It should match you. So yes, you need to update it. At the most 3 years, you should review it. How do you choose a great estate will plan and attorney? Ugh, too much wine. Me, if you're in Maryland and DC. If you're not, reach out to me. I do have colleagues in other states that are very similar. They practice the comprehensiveness that I do. They're very passionate about it, like I am. We all have different backstories, but definitely, if you're watching this and you're not Maryland or DC, just reach out to me. I'll give you a list of names of colleagues. You talk to them, see who you like best, and then decide what you want to do. I am not personally telling you to go with one of them. I'm just giving you people resources that you can go and you can speak to and decide what you want to do. But Maryland and DC, me. All right. So you guys are here. This is what you can do. You get a golden ticket. Normally, I have an actual golden ticket up on there, but it's Spooky Wine of Us. So we got the little ghouls and all that other stuff. So yeah, just go ahead and send me an email. You'll get a email after this, and you just contact me. Put the code Spooky, and you'll get a one-to-one session with me where we'll talk a little more about your situation and what's going on and what it is you're looking to do and stuff like that. And if you want to move forward, we will do a family wealth planning session. However, let me explain this. There's always a caveat to stuff, so here's your catch. We can do the family wealth planning session, but there is homework you have to submit before the session. If you do not complete the homework or do the homework before the session, us having the session, because that's me doing it with you now, the homework, that's going to be $750. Now, if you do the homework before the session and we meet, session is free to you. So we got to give and take. That's how it is. You do the homework, you get the session free. Don't do the homework, you got to pay the $750. But send me the code Spooky, and I'll know that you were on this webinar, so that I know that you get this deal, right? If you want to know my email now, let me know. I'll put it in the chat, because we are going to what? Wine bottle number 2, the red. So I'm just gonna have we're gonna quickly do that one. Shaniqua, do you have a red one as well, or you stayed with the Chardonnay?
I have a Moscato that's not red, but
you just went rogue on everything.
I went rogue. I did.
We'll
make it as if it's a rosé.
Wait, the rosé is not up yet.
No. I don't have one. I just have Moscato.
All right. Okay. Well, this is supposed to be the 2020 Waddle. I think that's how you pronounce it. I'm sorry if it's not. I know LJ don't get me. Crete Red Blend from California. I am going to try that and see. I'm more of a red person. Sweet works for me. Let's see. Make sure I swirl it. See, LJ, I'm swirling. Oh, it's okay.
That one's good.
It's like a semi-dry.
Yeah.
I don't like dry. I learned that with the last batch. I don't like dry at all. But it's like a semi-dry. But it's okay. I mean, it's doable. I still can't tell you what fruit I'm supposed to taste, but it's doable. I'm getting there, though. I'm getting there, because it's not sweet, but it's not dry. It's like,
yeah, I think that's the red blend is meant to be not too dry and then not too sweet.
Somebody said it's her husband's fault, of course. You know it is. See, I know that Dwayne's been on here before. Yeah, I'll blame my husband in a hot second. Love him dearly.
Telling on himself.
I know. I love him dearly, and he knows. But yeah, I will blame my husband in a hot second. Usually LJ takes up for him, but he's not here, so my husband's on his own. He is on this webinar, you know. That's my boo.
Hey,
All right,
Danny.
Shaniqua, you're up, hun.
All
You want
righty.
to
Now,
share your screen, or you want me to just
yeah, I can see if I can share it. Let's see. I'm not sure if I can. Oh, it says, are you?
Oops, sorry.
I don't know if it'll let me, Michelle, but if it does,
Hey, you should be able to right there. There you go.
you can see it.
Yes.
Okay, well, I can't see it. So y'all might see me looking over to my left. I have two monitors up. I don't know
Me
why
too.
I can't see it, but it's okay.
Me too.
All right, well, I will fly by this as well because I know we are
Mm-hmm.
trying to get through here. So I don't, you'll have to let me know what's actually
All right, slide number 2, you clicked.
okay. So I will start my part off with a famous quote by Benjamin Franklin. In this world, nothing can be said to be certain except for what? Death and taxes. How appropriate we can be morbid on this call, Michelle.
I'm
We can
just
talk
saying
about
that's my
death and
thing.
taxes, none of which we should be concerned of because it is inevitable. Both of them are inevitable. And two key differences is what I like to say. So, although that's a certainty for both of them, the only difference between death and taxes is that death doesn't get worse every time Congress meets. So, in that sense, death is a little bit more final, and whereas our tax code is constantly changing, which means that the one thing Michelle and I are here for is to make sure that everyone is planning accordingly. Um, and so that being said, I don't know. Michelle, is it still, are you able to see my screen now?
I still can see it. You're still on the Benjamin Franklin
Quote, okay.
slide. Mm-hmm.
I'm just trying to figure out how to get through to the next slide. Here we
There
go.
you go.
All right. So the first tax tip number one, max out retirement plan contributions. And that is a big one I see that people oftentimes don't take full advantage of. And I'll tell everybody, we just got through a big tax deadline. October 15th was the tax extension date. And I say the 15th, although the 15th fell on a Saturday. So it was extended to this past Monday, the 18th or the 17th. I'm sorry. And so what I found is everybody was at the last minute trying to ask questions about how much more they needed to have withheld, which could have been relevant as well. But what I like to tell people at first is take advantage of the things we can take advantage of. My saying is normally, if you can't figure out what to do with your own money, the IRS will certainly help you with that. And so it's for you to figure out what to do with your money so that they don't have to tell you where it should go to tax revenue. Typically speaking, and so this is relevant as we're in October and as we're coming up to the end of the year, everyone still has time to actually max out or contribute a little bit more if you realize you haven't done the max. And if you think you're going to be a little bit short this year, you actually have, most times you have up until December 31st or your last paycheck to contribute to your retirement account. And that's your employer sponsored 401k account.
Please understand, IRS, they have an estate plan for you as well. You just may not like it.
the
I'm sorry,
IRS,
you just may not like it.
the IRS and the state in which you live in has a plan for you should you
There
not
they go. There you
start
go.
your own. And so what I say is just don't be stingy about funding it. To Michelle's point, somebody else has a plan for your money when you don't know what to do with it. And so it is in your best interest to figure out the areas where you can contribute a little bit more. Pay yourself. That's my thing. Pay yourself before you pay anyone else. And the IRS is the someone else. So paying yourself would be to contribute to a retirement plan. How retirement plans work, most people don't understand it, but it is a above the line deduction, whereas whatever money comes out of your adjusted gross income. And so the money you put into these accounts reduces your taxable income for the year, which obviously reduces your tax bill. And there are many different retirement accounts, so we'll stick to just these two right now, the 401k and the IRA. But those two are, you use pre-tax dollars to pay into that system. And it, to Michelle's point about the estates, you're never going to avoid taxes. What we help you do is to minimize and decide when when taxes are more favorable for you to pay them. And so traditionally, when you are working your younger years, you're earning more, your income is a lot more. So it is beneficial for you to delay taxes until in your retirement years where, maybe your income is not as high when you're working. And so when you withdraw the money, it's at a lower tax base. And so just as a recap, the contribution limits for this year was increased, and it generally increases every year. For 2022, it's up to 20,500 and plus 6,500 if you are in the age category of 50 or older and you need to play catch up to contribute a little bit more to your retirement accounts. And that changes just a little bit if you have an IRA, which is not the employer sponsored account. It's the account that you can set up on your own through a traditional brokerage account. But the limits for that one is a lot lower, and it's only $6,000 per year and $1,000 in catch-up contributions. Tax tip number 2 is very similar because it is a savings account in a sense. It's not a retirement account, but it's one of these other accounts that is very misunderstood and underutilized, and that's your health spending account, your HSA accounts, if made available to you. And so like the 401k, I tell you to contribute as much as possible to your health savings account. These accounts are special in that they offer triple tax advantages on the federal level. And so the tax advantages that you get with the HSA is above the line deduction for contributing to the account. Any growth in that account is tax free. And I say that because the big plus to having an HSA account is that you don't have to use the money in the year that you put it in, unlike some other accounts, which means you could fund it to the max, let it grow, draw interest off of it, and you'll never be taxed off of any of the growth that are created inside of those accounts. And then obviously the big benefit for it is withdrawals from that account, unlike your 401k, are tax-free if used for qualified health expenses. And those expenses are a range of expenses for anywhere from paying for your co-pays at work to your contacts, eyewear, anything that falls under the category of health care and or dental would qualify you to be able to withdraw those funds out at a tax-free benefit. But the big way, and I like to describe it as this: if you earned $100,000 and let's say you funded this account with $10,000, if that were possible for your account, above the line deduction means that your adjusted gross income is no longer $100,000. Your adjusted gross income is now at $90,000, which means your tax liability is off of the lower amount versus being the amount that you actually generated income for. The other beauty in the HSA account is employers oftentimes will match your contribution. And unlike in your 401k accounts where you have to wait to be vested for that money to actually be your money, with the HSAs, there's no vesting period for it. You're able to use your employer matches with no limits traditionally, without having to wait to be vested. You can use them in the same year or same month that it was actually used in. So huge account.
You have a question.
Okay.
I thought those accounts all had to be used during that year.
Well, that is on, and the other account is, and I'll skip forward to, well, maybe I'll have it on here. So what you're thinking of is the flexible spending account is the same type of account, but the difference is on the FSA account, you do have to use that. The HSA doesn't have a requirement to use it up by the year. So I recommend, when possible, every employer is different. So I recommend when possible to put your money in the HSA account and not the FSA account. And it actually says it right here. So my key takeaways is a health spending account is a tax advantage way to save money. HSA contributions reduces taxable income. Investment growth in account is tax-free, and qualified withdrawals are tax-free as well. Money left over at the end of the year in the HSA is not forfeited like money left over in the flex spending account. So to your point, the FSAs absolutely have a requirement that if not used, and some employers give you a grace period to use it. I've seen them give like a 2-month after the 12-month period to allow you to use it. But traditionally, if you don't use it, you absolutely lose it. So you want to be, if at all possible, if you can choose this one over the FSA, this is the better account for you to put it in. The limits for this past year for individuals was 3650. Individuals and or families were 7300, and for 2023 that number is expected to increase as well.
Okay, you have a question.
Okay.
Qualified withdrawals, if you need it for non-health stuff, it's taxed.
Absolutely. And that is because this account is set up specifically for healthcare. So you can use your card, because typically speaking, you get a debit card or you get some type of way to have access to the funds. So you can use the funds however you like. If you don't use it for any type of qualified healthcare, and there's a whole list of things which I can share with everyone that qualifies it to be used as your healthcare account, you would absolutely pay taxes on it, because the IRS is saying we gave you the ability to leave this money out of your taxable income for this use and this use only. And if you're not going to use it for that, you will absolutely incur taxes and a penalty for having money into that account that you didn't use for qualified expenses.
Yeah, cool.
And Michelle, I can't see the screen, so thank you for saying that. So if there's another question, just stop me as well. So tax tip number 3 is probably by far my favorite one. So I don't know how many people have heard of this. I often have calls and they're like, what in the heck is this? But it's considered bunching deductions. And this is a very interesting way, especially since 2017 with the Tax Cut and Jobs Act that was passed. The standard deductions obviously increased, and as such, when it increased, a lot of people that used to be able to itemize deductions are no longer able or no longer seeing themselves being able to itemize. And so to bunch or not to bunch, maximizing tax benefits by concentrating or bunching charitable contributions. And so, like I said, in 2017, the TCJA became law. One of the biggest things that had happened in that reform was the standard deductions for everyone increased. They actually doubled. And so what that means is per filing status, those numbers changed. And that simply what that means is up to a certain amount is the amount of money that you can make before you're starting to be taxed on it. So if you were a single taxpayer, $12,950 for this past year is the standard deduction. And if you're married filing jointly, $25,900 is the standard deduction. And so what that means essentially is that if you had less than that amount of money in itemized deductions, it doesn't matter. You won't be able to claim it. Or you could, but it wouldn't be beneficial, because obviously you're getting more bang for your buck by just doing the standard deduction. And so what we find is a lot of people are over making contributions or over funding things that really are not going to be beneficial for them. And I hope I don't offend anyone when I say this, but I see this often when it comes to like church tithes. And I know some people, I have clients of mine who actually, they contribute or they pay their church tithes and they don't actually expect to write it off on the taxes. But the great majority of people pay church tithes, and they are the first ones to give me the receipt saying, look and see how much I paid in church tithes. And then oftentimes they're sorely disappointed that they don't get a chance to actually write those deductions off. And the reason being is because they don't have enough in total itemized deductions in order for them to write it off.
Okay, so there was a comment for you.
Okay.
It says, Vance said, wait a minute. Bigger thing you said was it's a tax write-off. All other means depend on employees, HSA, same as supplemental insurance. But there's a question. Can employees write off their portion of their medical expense that they pay?
Anything above and beyond. So you can't double dip on taxes, right? You can't double dip on tax deduction. So if you paid it from out of the HSA account, then no, you cannot then turn around and write it off as a deduction on the taxes. However, some people who have higher that are above and beyond what you can do as the max contribution into the HSA accounts, you can do that as a deduction. But that is a great question, because if I see people under contribute to the HSA account and then turn around and still have deductions, and it actually falls into this bunching category, because you have to itemize in order to even write off any medical expenses. However, that's a little bit tricky because you can't just write off them. You have to have at least 7.5% of medical or dental, medical and or dental, in order to even write it off. So for instance, if you made $100,000 in a year, your medical and dental has to be at least $7,500 in order to claim that deduction. If it's under that, you don't even get a chance to write it off. So it is a better bang for your buck to pay using pre-tax dollars in that scenario. And honestly, in most scenarios, it's better to use pre-tax dollars to pay off that, because like I said, that's above the line deduction in order for you to do it. And we call, when you're doing it as a deduction via itemization, it's an after the fact deduction, meaning you have to at least meet the minimum threshold to even begin to deduct it.
Oh, sounds
Great.
good. I think what we're going to do is we're actually going to put together a part 2 to this, because I think it's so much information that we want to give to you guys, and you have like great questions that I didn't expect, but it's a welcome. It's a welcome thing. So I think we need to do a part 2, and we'll continue. I'll go more into my stuff. Shanika will go more into hers. I just want to put up, if it'll let me. Oops. Sorry, guys. I'm having technical difficulty here. That's what happens when, hubby leaves me alone here. But where is it? Here we go. So I just want to put up our contact information. Can you see my screen?
I can see it now, Michelle. I think I stopped sharing.
Okay, so there was a third wine. We don't have time for me to taste it, but it's a sparkling rosé. I can let you know how it goes. If you're on my newsletter, you'll know, because I'll talk about it. And so thank you, because we're already like 3 minutes over.
Thank you.
Oh, wait, there was one question. Wait, Vance got it in. Thank you, Dwayne. You talking about great job. And he said, boo. I love it. I love it. Spooky wine and wills. I know. So he said, I cracked myself up. That is hilarious. He said, my apology. Oh, this is for you. Thank you, Derek. This is for you, Shaniqua. My apologies. I meant their monthly expense that they pay every pay period, not the HSA.
Yes.
Reg medical health coverage.
Yes.
Thanks, ladies, enjoying this program. I'm drinking OJ. Vance, you got to show up when we have all 3 people. We got the wine guy, myself, and Shaniqua. You got to show up. We have a whole lot of fun with that. But here's our contact information. Absolutely, please take a picture. You will get a replay of this. You'll get a replay of this, and we will do a part 2, because I just think it's a lot of information that people want. And I think we're saying it in a way that, is layman's terms, makes sense. But somebody said they're calling you tomorrow, Shaniqua.
Awesome. Hey, Michelle, I'll be here.
So I love it. I love it. I love it. Thank you guys for showing up. Thank you for all the questions and interactions. So we're going to go ahead and end this. Shaniqua, I'll probably call you tomorrow as well. I'm going to try this rosé, and we're going to see how it goes. Thank you, guys.